Hello, Inflection Point, what's next? Before we get into what's next, let's go back and review what the inflection point was the last time we got together, and I'll give you a few updates of where we are, and then we'll get into what's next. Remember, the inflection point from the financial standpoint is when the federal funds rate, interest rate, goes above, it's higher than the U.S. 2-year Treasury rate. And you can see on the graph, the far left, just almost 1 year ago is when the Federal Reserve started to raise interest rates in March. 2 weeks from now, it'll be a year. And they were way behind the curve. You remember we mentioned that. Well, they've caught up. Look at the blue line, which is that stair-step Fed funds rate. It's now equal to the interest rate market. And lots of change, significant changes. So the Fed funds rate is equal to or higher than the 2-year Treasury rate, which talks about inflection point and typically signifies the coming of the end of the interest rate movement. In other words, the Fed is probably 2 to 3 interest rates from being done, and probably within 6 months of finishing the job of raising interest rates. That's what history shows in the last 50 or 60 years. Inflation, obviously, you see a big bump and spike up in last summer. This is June or July. Today, the rate is running about 6.25. You'll see that continue going down. Interesting, if you go back and listen to the slides and presentation we had in May of 2022, this is crazy, but about 6 points. It's all unrolling like was said, and the reason being these macro events, money supply, interest rates, Federal Reserve, follow an actual plane. There's a cause to these actions they take. So let's take a look of money supply, or the rate of change. And this is a 50 to 60 year graph, a lot of squiggles, but you'll notice the supply of money typically grows about a 5.5–6% a year. Just like the economy needs supply of money. Just like the fire or your grill when you're cooking needs oxygen, just like fuel to the automobile. Okay, so a 6% average growth. There's 5 times in the last 50 years that the supply of money or the growth of money has actually been below zero. You see that on the bottom of your screen. This is a significant change. Liquidity causes a lot of change. Let's take a little closer look at that. This is the last 6 months rate of change. And look how last summer you can see the rate of change or negative growth started to happen. You see the first bump down, and then December was an additional extraction. Look at the last month. Now, we don't know if this is a trend, but I didn't see this until I put this slide together, that money supply or the growth of money has been negative for the last 6, 7, 8 months. It just went really north, a really fast-paced increase. We'll see if this is trend, what happens, okay? This is the interest rate curve in the United States, and we call this an inverted curve. I used this a couple times ago. You'll see the 6 month and 1 year up towards 5%, and the farther on the right of the screen, you'll see the 10-year Treasury at 4%, and a 30-year Treasury even below that. So it's called an inverted yield curve. And when inversion happens, things start to slow. Well, let's think, why does that happen? Well, the banks like to borrow low and lend high, right? Well, what are we getting paid on our CDs and our money markets and interest rates versus euro? We're getting paid 4 to 5%. So the bank's cost of money is a lot higher than it was, which is a deterrent for them to extend credit. They can get 5% overnight Fed funds. Why would they take risk of loaning for a new truck or anything else? There's an incentive for less risk. So inverted yield curve, very important. You'll see this is a 60-year chart, and the line on the bottom demarks even money. The interest rates for the short rate is equal to the long rate. And look, again, there's 5 times in the last 50, 60 years that the short-term rates, this is a 3-month Treasury bill, is 1% higher than the 10-year United States Treasury. That's the largest spread we've had, and it says that the curve is very inverted, which means things typically slow down, which again goes back to our thesis of the entire money supply, market, interest rates with economy, liquidity. It's all very connected. So our inflection point, the scenario, consumer spending, all the excess savings from the pandemic have been spent. They're back to the 2019 level. Wages still increases, but modest, not the 8, 10, 12% we had in the last year or two. Housing, well, there's no supply of housing. It's hard to have a crash on anything if you don't have a supply, right? There's no supply, and the sluggish demand of higher interest rates really cut down on the demand. People said, I don't want to borrow 7.5, and no supply. If you have a mortgage on your house, which 85% of the United States mortgages are fixed between 3 and 4%, you don't want to sell your house and trade a 3% for 7.5. So there's just not many houses on the market. Commodity prices have stabilized. Money supply growth is negative. Despite the last month, it's still growing at a negative rate, meaning it's shrinking. We'll see if the last month develops into a trend. New bank credit slowing. A couple reasons I mentioned before. One of them is if the banks can get 5% free at the government window, why would they even loan money and take risk of not getting it back? In addition, the interest rates are higher, less people want to borrow. Federal government spending is stabilizing. It was massive during the pandemic, right? They spent lots and lots of money, but it's slowed down. It's a good thing, but it also slows the economy. The U.S. dollar, in comparison to other currencies around the world, is softening, and supply chain is healing, as we all know. So things are changing, things are slowing down by definition, and that's all what's supposed to happen, at least from the Federal Reserve standpoint. So our point, what's next? Short-term rates probably go higher the next 6 months by 0.5% or so, maybe 2 or 3 increases left. Long-term interest rates, probably not much going to change. Inflation, which we're running about a 6.5%, probably going to be closer to 4% by mid to late summer, and by year end, we think there's a good shot it's going to be between 0 and 3%. And again, remember, if we've got an aircraft carrier, to turn that aircraft carrier, it's very difficult to stop it on the dime. So when it goes from 9% to 2%, very likely go lower. Equities and bonds are very attractively priced today, we think. The other thing, economic reports, what's next? This month's a big month. We got March 10th, 14th, and 22nd. 3 big reports, the jobs report, the February CPI report, and FOMC's, the Federal Reserve Market Committee, where they report what they're going to do in March. And one thing I want to remind you is this year is a 3rd year of the presidential election cycle, right? There's 4 years, has been for a long time. So the left side of this graph says, hey, the second year of this 4-year cycle, you see a 4.3% number. That's the average return for the second year of the presidential cycle of the stock market. The 3rd year is up to 13%. These are 100-year statistics. The right side of this points to the point here. If the second year is negative of 15%, that's the average when they are negative, and we had a negative 18%. The 3rd year, which is where we're in, is even more positive. So things change, and we'll see what happens. So our view is that we're slowing. It's a good thing. Things are going to come around. We really went through the pandemic up and down, and we're really come back to the same plane as the economy was on pre-pandemic. So lots of noise for 3 years, but if you're listening, you still made it and survived, and I suspect we'll do just fine. So look forward to having questions, and take care.